Hey everyone, Assalamu alaikum and welcome to ACCA revision session for paper F7, financial reporting. So welcome to ACCA revision session for paper F7, financial reporting. Today is day 4, 16 November 2017, and we are going to start today's session. Today's day 4, we have already covered the areas of day 1, day 2 and day 3. We have discussed multiple accounting standards in day 1 and day 2. And then we have solved 3 different questions of final accounts in day 3. Now we're going to discuss the consolidation of the final accounts, and we are going to solve 2 questions, Dargent and Laurel. In tomorrow's session, tomorrow will be the last session for where we're going to discuss the ratios, and then day 6 will be the mock exam and the mock debrief. So let's start today's session with consolidation. First of all, you should be aware of some basic workings that we perform in consolidation. Working number 1 relates to net assets, where we are going to calculate the net assets at acquisition and net assets at the balance sheet date. Now, what do we mean by net assets? The word net assets actually means total assets minus total liabilities. The word net assets means So the word net assets means total assets minus total liabilities. But if we remember that you would have studied that assets is equals to liabilities plus equity. Okay, actually my hand is clicking on the keyboard. So let's remove the keyboard. Okay, so you would have studied that assets is equals to liabilities plus equity. And if we bring the liabilities over here, so the total assets minus total liabilities would also mean total equity. So calculating, I think it's not the keyboard problem. So total assets minus total liabilities is equals to equity. So we can calculate the net assets either by deducting total assets minus total liabilities, or we can even calculate by using total equity. Okay, just give me a minute. The system is working on its own. Okay, so now over here we calculate net assets and when we say total equity, we mean ordinary share capital, retained earnings, and any other components of equity. The word other components of equity actually means share premium. The word other components of equity actually means share premium. And further, if there is any fair value adjustment, we are going to record that fair value adjustment both at the date of acquisition and at the date of balance sheet. Now this is the total of the net assets at the date of acquisition, and this is the total of the net assets at the date of balance sheet. If we calculate the increase in this net assets, this is going to be the post-acquisition profits. So the post-acquisition profits is the increase in the net assets from the date of acquisition to the date of balance sheet. So for example, if the net assets at acquisition were 100 and if the net assets at balance sheet are 120, so the increase is 20, which will become the post-acquisition profit. And this will be divided between the parent and the NCI according to the holding percentage. So for example, parent has an 80% holding percentage and NCI has a 20% holding percentage. So the value allocated to parent is going to be 16 and the value allocated to NCI is going to be 4. So the first step is to calculate the net assets at acquisition and at balance sheet, and then distribute the post-acquisition profit between the parent and the NCI. Now this net assets at acquisition will further be taken to working number 2, which is going to be goodwill, where we calculate goodwill as cost minus the net assets acquired. So these are the net assets that we have actually acquired, and these will be used to calculate the goodwill. Similarly, the parent's share in the profit will then be taken to the retained earnings, which will be working number 4 in our case. and the profit that is attributable to NCI will be taken to working number 3, which is the profit of NCI. So this is a basic working that you should be aware of. Simran is asking that whether I will be explaining the principles of consolidation. Simran, actually, due to shortage of time, we will be more exam focused and less discussion over the theory areas. Okay, so now this is how we are going to calculate the working number 1, and then we have working number 2, again part of the basic workings, which we call is goodwill. Now there are two goodwill methods, full goodwill method and the partial goodwill method. Both are allowed, but the question is going to decide which goodwill method is required by you to be followed. So the examiner may require you to follow the full goodwill method, or may require you to follow the partial goodwill method. Now let's start discussing the full goodwill method first. The method is that we are going to use the cost. For example, we have acquired 80% of the shares. So 80% cost of 80% shares. And then we are going to add the fair value of NCI, the fair value of the remaining 20% shares, which is going to become the cost of 100% of the shares. And then we are obviously going to deduct 100% of the net assets from working number 1, and we are going to get the goodwill. And this goodwill would relate to 100% of the shares. So this is called full goodwill method, where the goodwill relating to 100% of the shares is being recorded. Okay, Simran, we will discuss how to calculate the fair value of NCI. And if, for example, we are at the partial goodwill method, we are going to take the cost of 80% shares, and we are not going to add any value of the NCI. So the cost would relate to 80% of the shares. Therefore, the net asset should also be 80% of the net asset. So we are going to get the goodwill, which relates to 80% of the shares. So now this is the goodwill which actually relates to parent only. That's why this is called partial goodwill method, where goodwill of subsidiary is recorded at parent's share only. So we actually record the parent's share only, not the entire goodwill. But in case of full goodwill method, we record the entire goodwill of subsidiary. So this is the difference between the full goodwill method and the partial goodwill method. Now, how do we calculate the fair value of NCI? The fair value of NCI is pretty simple. Fair value of NCI is equals to NCI shares, NCI number of shares multiplied by the market value per share. So if the question has provided you the share price, of subsidiary, then you are going to calculate the fair value of NCI using that share price. So in every question where the share price of subsidiary has been given, it actually relates to the calculation of the NCI. Walaikum assalam, Hamzali. Yes, when we say equity, we mean all equity, whether it's share capital, share premium, revaluation reserve, retained earnings, any of the component of equity. Simran, OCE means other components of equity such as revaluation reserve, share premium, or any other component of equity. Smita wants a screenshot of the previous slide. Here you go, Smita. Simran, 80% is the, just a second. Okay, Smita, I hope you have taken the screenshot. Let's move on the next slide. Simran, I've already discussed how to calculate fair value of NCI. Number of NCI shares multiplied by the market value per share. Number of NCI shares multiplied by the market value per share. Harsh is saying that on consolidation, aren't supposed to full assets of the way owns 100% of the subsidiary. Yes, Harsh, you are right. We always take 100% of the assets, but in goodwill. But in goodwill, we have an option either to take 100% of the goodwill or to take the partial goodwill method. Simran, market value of subsidiary to calculate NCI. We are going to use market value of subsidiary to calculate the NCI. Walaikum assalam, Shiza Salim. Mahin Salahuddin is asking, how can I ask question to Saramza? Mahin, you can simply post it over here. I am able to read all of your chat box messages. Okay, Sayyid Mahaz is asking for the answers of practice questions relating to day 2. Okay, Mahaz, I will provide you today. Simran is asking, is the share price of parent owner subsidiary? Okay, already discussed. Walaikum assalam, Simian. Okay, so now we were discussing the goodwill, that we have two goodwill methods, full goodwill or the partial goodwill. If you're following the full goodwill, we are going to use the cost of 80% or 60% or whatever percentage of parent's holding is. And then we are going to add the fair value of NCI. And how do we calculate NCI? Number of NCI shares multiplied by the market value per share. And this way we are going to get the cost relating to 100% of the shares. And then we are going to deduct the net assets of 100%, and we are going to get the goodwill relating to 100%. But in case of a partial goodwill method, we are going to use cost relating to parent only, and we are not going to add the fair value of NCI. This way the cost will become 80, the net assets will be 80, and the goodwill will be 80. Now actually full goodwill method is the new goodwill method because it is more I would say it shows a more true and fair view, because when all of the assets of the subsidiary are consolidated at 100%, so the goodwill should also be consolidated at 100%. Okay, Shiza is asking fair value of the net assets. Shiza, fair value of the net assets relates to the previous slide. In working number 1, we would have calculated, and I've written these are the net assets which are taken to goodwill. So I think you have joined late. Quickly take the snapshot so you can review later. Yes, Simran, question will clearly mention which goodwill method to be used, partial or the full goodwill method. Yes, Harsh, the examiner will tell you which goodwill method to be followed. Yes, Sheikh Saqib, all of you people are asking the same question. Everything will be given in the question. You don't have to do anything. You just have to follow the method given by the examiner. Okay, now let's discuss the working number 3. Working number 3 is actually NCI. Now NCI will also differ according to the goodwill method. If the goodwill method is full goodwill method, we are going to start from the fair value of NCI that we have also used over here. The same value that we have used over here in the goodwill, the fair value of NCI. And then we are going to use the share of profit which we have calculated in working number 1. So the fair value of NCI is coming from working number 2, and the share of profit is coming from working number 1. So this will be the value of the NCI. Share of profit will remain the same in the partial goodwill as well, coming from working number 1. But the difference will be that there is no fair value of NCI in this case. So from where to start the partial goodwill method? As there is no fair value of NCI in this case, so from where should we be starting the NCI? So for that it is pretty simple. We are going to use the net assets. The net assets at acquisition multiplied by the NCI percentage. In case of partial goodwill method, we are going to use the net assets that were at the date of acquisition, which we have also used over here. So the net assets 80% will be taken to goodwill and remaining 20% will be taken to the NCI. So you have to remember both the goodwill methods, the partial goodwill and the full goodwill, because the question can even be asked in the MCQs. So there can be a question where the examiner asks you to calculate goodwill if it was partial, and calculate goodwill if it was a full goodwill method. Okay, I'm repeating the NCI for the partial goodwill method. Let me clear this because already a lot of material has been written. So sometimes a full slide also confuses the students. Okay. Okay, I'm repeating again. Student, I have muted the mic. I was not saying anything, so you haven't missed out. So I'm removing all of the material so that you people can understand again. Okay. Now let's suppose that we have purchased 80% of the shares for $100 million. We have purchased 80% of the shares for $100 million, and the fair value of NCI was 20, so the total cost is 120. And the net assets acquired were 80, so the goodwill was 40. This is a partial goodwill method. The cost was 100, fair value of NCI was 20, total was 120, net assets acquired were 80, so the goodwill is 40. Now we are going to use the same fair value of NCI in working 3. And then we are going to add the share of profit from working number 1 to calculate the total NCI. Is this clear to everyone? The full goodwill method. Any confusion with this? I will move on slow so that you people can understand properly. Simran still thinks fast. Let me read again. Simran, I am the parent. I have purchased 80% of the subsidiary's shares. I have purchased 80% of the subsidiary's shares for $100 million. I've paid $100 million as the cost. And the fair value of remaining 20% shares is, let's suppose, 20 million. So the total sum is going to be 120. And the net assets at the date of acquisition were 80. So I've deducted 80 to calculate the goodwill of 40. Is that clear, Simran? And then the fair value of NCI has been used again in the working number 3 to calculate NCI. And then we have added the share of profit. Now, for example, I move on towards the partial goodwill method. The cost is going to remain the same even in the partial goodwill method, which is 100. But we are not going to add the fair value of NCI, and the total value will become 100. This time the net assets are not going to be 80. Instead, they are going to be 80 million of the net assets into 80% of the shares acquired by the parent. 80 million of the net assets at acquisition into 80%, which will become 64 million net assets acquired, and the goodwill will become $36 million. So this is how we calculate the partial goodwill method, the cost paid by the parent minus the net assets acquired by the parent. So the parent has actually acquired 80% of $80 million. Now, when we are going to calculate the NCI, the share of profit will remain the same as in case of full. Okay, so the share of profit will remain the same as in case of full, but the value of NCI is going to be $80 million, the net assets that were at the date of acquisition, and NCI has a 20% share in this, which will become $16 million. So in case of partial goodwill method, we are going to start from 16 and not from 20 because we are following the partial goodwill method. So this is how we are going to calculate NCI in this case. So actually, if you see, the difference between both these values is 4, and the difference between both these values is also 4. So the difference will always be the same between the goodwill partial full and the NCI partial full, because this 4 actually relates to the goodwill of NCI. This 4 actually relates to the goodwill of NCI. Is it clear to everyone? Okay, Simran is asking to repeat again. Smita is saying 4 relates to what? Simran, 4 relates to the goodwill of NCI. If we see, the fair value of NCI was 20 and the net assets relating to NCI was 16 at the date of acquisition. So 4 is the goodwill of subsidiary, and this is the NCI's share of goodwill of subsidiary. So actually the fair value of NCI is 20 and the net assets of NCI is 16. So the goodwill of NCI is 4. So the difference is actually 4 between both the cases. No, Young. The partial goodwill method means that we are going to calculate the share of goodwill of parent only. We are going to calculate the goodwill of subsidiary relating to parent only. Now let's continue further. We are going to solve a complete question. I'm sure a lot of problems will be solved over there too. So now the working number 4 is going to be retained earnings, where we are going to start from parent's retained earnings. This is the parent's retained earnings. And then we are going to add share in subsidiary's profit. And then we are going to add share in subsidiary's profit, which is coming from working number 1. So after adding this, we are going to get the final retained earnings balance. So parent's retained earnings plus share in subsidiary's profit is the group retained earnings. Now let's solve a question so that you people can be able to understand in more detail. I'm moving towards the OneNote. I'm moving towards the OneNote so that you people can understand easily. So this is a past papers question by the name of Dargent. Let's start this. So I have a sheet by the name of Dargent and one sheet by the name of answer to Dargent. So I'm going to solve the answer over here, and this is sort of my question paper. so that you people are aware of what things have to be written on the question paper and what things have to be written on the answer sheet. So let's start discussing. The question says that on 1st January 20x6, Darjan Company acquired 75% of Latre Company's equity shares on January 20x6. On January 26, Darjan Company acquired 75% of Latre Company's equity shares by means of share exchange of 2 shares in Darjan for every 3 shares in Latre Company's shares acquired. So we have actually acquired 75% shares and we have made a share exchange giving 2 shares for every 3 shares. So if I go and see the number of shares of the subsidiary, the equity shares of subsidiary is 20,000 with a par value of $1 each. So the number of shares are 20,000. Okay, everyone. So now are you all able to hear me properly? Can you all hear me properly now? Yes, that's good. So actually we have most probably resolved the issue. So we can continue now. And I'm going to start the discussion from the scratch. So the question is said that on 1st January 20x6, Darjan Company acquired 75% of Latre Company's equity shares by means of share exchange of 2 shares in Darjan Company for every 3 Latre Company shares acquired. So there were total 20,000 shares of the subsidiary company, and we have actually acquired 75% of them. So this would become 15,000, and into 2 divided by 3, we have issued 10,000 shares of our own. We have issued 10,000 shares of our own. On that date, which means on the same date, further consideration was also issued to the shareholders of Latre Company in the form of a $100 8% loan note for every 100 shares acquired in the Latre Company. So we have further issued some loan notes as well. So we have acquired 15,000 shares into, we have issued $100 loan note for every 100 shares. This 100 is actually the loan notes, $100 loan notes for every 100 shares. So this means that we have also issued loan notes with a consideration of $15,000. So we have given the consideration of 15,000 loan notes along with the 10,000 shares. Now the question further says that none of the purchase consideration nor the outstanding interest on the loan notes on these 15,000 at 31st March 2006 had yet been recorded by Darjan Company. So neither the consideration has been recorded nor the interest has been recorded, so we have to record both. At the date of acquisition, the share price of Darjan Company and Latre Company is 3.2 and 1.8 respectively. Now the question is given us both the share price. Which price should we use? Parent share price or subsidiary's share price? Should I multiply this with parent's share price or subsidiary's share price? What do you people think? Parent. Yes, obviously parent share price, because the number of shares are also of parent. So 10,000 into 3.2 will give us $32,000. So I would say that the total consideration is actually $47,000. This is the total cost of 75% of the shares. This is the total cost of 75% of the shares. But the question is, why has the question given us the subsidiary's share price? Why is the question giving us the subsidiary's share price? That is because to calculate fair value of NCI. So if we see, out of 20,000 we have acquired 15,000. Out of 20,000 we have acquired 15,000. So remaining 5,000 belongs to the NCI and the share price is 1.8. So that would become a total of 9,000, which will become the fair value of the NCI. So subsidiaries shares were total 20,000. We have acquired 15,000. So the remaining is 5,000, which belongs to NCI. And each share is of 1.8. So the total shares of NCI would become of $9,000. So this is the value that would belong to NCI. This is the value that would belong to NCI. Okay, Simran wants to understand the loan notes again. Simran, the question had said that we have issued a $100 loan note for every 100 shares. $100 loan note for every 100 shares. So we have acquired 15,000. We have acquired 15,000 shares into $100 loan note divided by for every 100 shares. So into 100 of the loan notes divided by for every 100 shares. So that has become that we have issued 15,000 loan notes. And we have done all this on 1st January 20x6, and our year end is 31st March 20x6, which makes it 3 months. So we have acquired the subsidiary 3 months before the year end. So now I'm going to write the entry. Now I'm going to write the entry on the next slide. Over here, I'm going to write the double entry. So adjustment number 0, I'm going to call this. And this is investment in subsidiary debit, share capital and share premium credit to record the share exchange, and then investment in subsidiary debit and loan notes credit to record the loan notes, and then finance cost or retained earnings debit and interest payable credit to record the 3 months interest on this. So the loan notes were actually of $15,000. So investment debit loan notes credit for $15,000. And for the share exchange, the value was 32,000, which with 10,000 shares. So as the par value is 1, so the share capital will be recorded at the par value. So this is going to be 32,000 investment debit. Ordinary share capital credit by 10,000 and 22,000 will belong to the share premium. SP means share premium. OSC means ordinary share capital. So 32,000 in the investment, 10,000 as the share capital and 22,000 as the premium. And then 15,000 for the loan notes. And now we are going to record the interest on these. So if I check the interest rate on the loan notes, it is actually 8%. The interest rate is actually 8%. So I'm going to calculate 8% using a calculator. So this is 15,000 into 8 divided by 100. So this is the annual interest into 3 divided by 12. Will give me 3 months interest, which is 300. So I'm recording the entry as finance cost debit, interest payable credit by 300. How have we calculated 300? 15,000 of the loan notes into 8% of the interest rate into 3 divided by 12. This is the procedure that we have followed to calculate the interest. Simran is asking what is FC/SRE. Simran, FC stands for finance cost or retained earnings. It is the same. If we are preparing an income statement, we will write finance cost. And if we are preparing the balance sheet, we would write retained earnings. And if you're confused, you can write both. So I've written both so that we can understand what impact this would have on the income statement and what impact this would have on the balance sheet. So in a balance sheet question, we write retained earnings. In the income statement question, we write finance cost. And it's better to write both. Okay, Akbar Naveed is asking, sir, these entries will only be made in the consolidated books, right? And not in the individual books. Yes, Akbar. These entries mainly relates to the consolidated books. So we are actually preparing the consolidated, so we are concerned for the consolidated. We have no concern with the individual books. Interest payable will be recorded as a current liability. Interest payable will be recorded as a current liability. This is a current liability. Interest payable will be recorded as a current liability. So now we are done with the adjustment number 0, where there was no adjustment reference, no number 1, 2, 3, 4, nothing. So I've called it adjustment 0. Now the question says that the summarized statement of financial position of the two companies as at 31st March 26 are. Now the question has given us the balance sheet. Let's have a quick overview of this. We have the property, plant and equipment, and there's a note number 1 relating to this. We have investment in Amray at 1st April 20x5, which means probably at the start of the year, because our year end is March 20x6. So at the start of the year, we have made some investment, and the word Amray seems to be an associate to us. Maybe we are wrong, but seems to be an associate to us. Yes, Simran? The word Amre seems to be an associate, but the question has not clearly defined this. Similarly, we have inventory with note number 3, receivables with note number 3, and then we have bank, equity shares, retained earnings at the start of the year, the profit for the year, 8% loan notes, and then we have current liabilities. So if I prepare the working number 1 in my answer sheet, I'm going to start working number 1, which means net assets. And it has 2 columns, net assets at acquisition, net assets at balance sheet, and I'm going to write the entire equity section, which actually contains only 2 elements, share capital and the retained earnings. There are only 2 elements in the equity section of the question, equity shares and retained earnings. So the equity shares were 20,000 and the retained earnings at balance sheet date are going to be 27,000. Opening 19 for the year 8. So if I write over here, I'm going to say the retained earnings opening was 19,000 and the profit for the year is 8,000. So the retained earnings at the balance sheet date are going to be 27,000. So retained earnings at the balance sheet date is 27,000. So if I go over here, I'm going to write 20,000 share capital at acquisition at balance sheet and 27,000 of the retained earnings at the balance sheet date. Simran, do you want me to repeat again, or are you clear with this? So opening retained earnings were 19,000. Opening retained earnings were 19,000 according to the question, and profit for the year is 8,000, so the closing would become 27,000. Opening is 19, profit for the year is 8, so the closing is going to be 27. Now we have acquired the subsidiary 3 months before the year end, somewhere over here. 9 months after the start of the year and 3 months before the year end. So can you tell me the retained earnings at the date of acquisition? Can you calculate the retained earnings at the date of acquisition? Can you tell me the retained earnings at the date of acquisition? Harsh is saying 25. Akbar is saying 6. Syed Maz is saying 3,500. Faraz is saying 27. All different answers. Actually, to calculate the retained earnings at the date of acquisition, there are 2 methods. Either add 9 months profit in 19,000. Either add 9 months profit in 19,000 or deduct 3 months profit from 27,000. Both will give you the same answer. Add 9 months profit in 19,000 or deduct 3 months profit in 27,000. Both ways you are going to get the same answer. Let me calculate both methods for you. So 8,000 into 9 by 12 is going to be 6,000 for the first 6 months, and which means 2,000 for the remaining 3 months. So either add 6 in 19 or deduct 2 from 27. Either add 6 in 19 or deduct 2 from 27. So the retained earnings at the date of acquisition were actually $25,000. So these are the retained earnings at the date of acquisition, which we are going to write in the net assets at the date of acquisition. So both the treatments are correct, 19 plus 6 or 27 minus 2. Both will give us the same answer. Yes, Faraz, you are right. Ahsan, Smita, Waheed, a lot of right answers now, Akbar. Okay, now back to the question. Now let's start reading the adjustments. And we will be incorporating the adjustments into working number 1. So let's start. The question says that at the date of acquisition, the fair value of Latric Company's assets were equal to their carrying amounts. At the date of acquisition, the fair value of Latric Company's assets were equal to their carrying amounts. However, Latry company operates a mine which requires to be decommissioned in 5 years time. Decommission means to dismantle. Decommission means to dismantle. No provision has been made for these decommissioning caused by Latry company. No provision has been made. So if we record the provision, the entry should be property, plant and equipment debit and the provision credit. So the question has actually not recorded the property, plant, equipment and the provision. The present value discounted at 8% of the decommissioning is estimated at $4 million. So the property should be recorded at 4 million and the provision should be recorded at 4 million and will be paid 5 years from the date of acquisition, the end of mine's life. So this will be paid after 5 years. So the asset will be increased by 4. Asset means 4, Simran. Asset means property, plant, equipment. So we are increasing the asset by 4 and we are increasing the provision by 4. And we are doing this thing at the date of acquisition. Now, if I move to my answer, I'm going to write the fair value adjustment relating to property, plant, equipment and relating to provision, which is a non-current liability. This is a provision for dismantling, for decommissioning. So I'm going to write 4 million, which is 4,000 because I'm performing my answer in thousands. And then I'm going to increase the liabilities provision as well by 4,000. So the increase in asset will actually increase my net assets. The increase in asset, property, plant, equipment will increase my net assets. And the increase in liability will actually decrease the net assets. So that's why I'm going to write this 4,000 as a negative. Property, plant, equipment debit will increase the net assets. Provision credit will increase the provision and decrease the net assets. So that's why we are adding 4 and then deducting 4. So the net impact is 0. The net impact is 0. But this is the impact that we have written at the date of acquisition. What about at the date of balance sheet? What values should be written at the balance sheet date? Now the important thing is that we are going to depreciate the asset over 5 years and unwind the liability by 8%. I'm going to answer you, Simeon and Simran, but just a while. So we are going to depreciate the asset at the balance sheet date for over 5 years. And secondly, we are going to unwind the liability using 8%. So if I calculate the depreciation, this is going to be 4,000 divided by 5 years, and only 3 months have actually passed by. Only 3 months have actually passed by, so I'm charging 3 months depreciation. So this is going to be 4,000 divided by 5, annual depreciation of 800 into 3 divided by 12 will give me 3 months depreciation, which is of 200. So the asset will be depreciated by 200 and the balance sheet date we are going to write it at 3,800. On the balance sheet date we are going to write it at 3,800. Yes, thank you everyone. And similarly, the liability, the provision will be unwound using 8% and again 3 by 12 because only 3 months have passed by. So 4,000 into 8 divided by 100 will give me the unwinding relating to the entire year, and into 3 divided by 12 will give me the unwinding of 80. So the value at the balance sheet date of the provision is going to be 4080, and as it is a liability, I'm going to write it as a negative value. Yes, Wahi, thank you. So this is how we have incorporated the fair value adjustment in the working number 1. We have added 4,000 in the assets and 4,000 in the liabilities at the date of acquisition. And then we have depreciated the asset and we have unwound the liability. Now Simeon and Simran had a question that why are we increasing the asset? Simeon and Simran, this is basically a case of dismantling. Decommissioning means dismantling. And if you remember, we have discussed the accounting of dismantling and decommissioning in day 1, IAS 16, property, plant and equipment. So there are total 3 impacts: that we capitalize the dismantling cost and the cost of the asset, and then we depreciate it along with the asset, and then we unwind the liability. So these are the 3 things that we are performing in this case as well. So this is basically IAS 16. So if you're not if you're not aware of this accounting, please refer to day number 1, where I've discussed dismantling cost. I've even solved one of the questions over there, so it will be easier for you people to understand it completely. The accounting entries, the impact in the income statement, the impact in the balance sheet. I've discussed everything in detail over there. Okay, now, so adjustment number 1 has been done. Let's move back to the question. Where the question says that Darjan Company's policy is to value the non-controlling interest at fair value at the date of acquisition. Now, this is where the question is telling us the full goodwill method, that our policy is to value NCI at fair value. In which goodwill method do we value NCI at fair value? In the full goodwill method. So this means the question is referring us to follow the full goodwill method. This means that the question is referring us to follow the full goodwill method. Latre Company's share price, which was 1.8 informed us earlier, at that date can be deemed to be representative of the fair value. So that share price, which was 1.8, is representing the fair value of the shares held by the non-controlling interest. So we have actually used the same 1.8 into 5,000 NCI shares to calculate the fair value of NCI. So we have actually already done this thing, but the question is telling us that to do this. So even if the question would have not mentioned this, we would have done the same. Yes, Maz, your entry is correct. Simran, whenever the question would say that value the NCI at fair value, whenever the question will say value the NCI at fair value, this means full goodwill method, because NCI is valued at fair value in which method? In full goodwill method. So whenever the question is going to say calculate NCI using full goodwill at fair value, that would become full goodwill. Smith is asking times 15,000 or 5,000. Simeon, 15,000 were the shares acquired by parent. 15,000 were the shares acquired by parent, Smith. And 5,000 is the share that belongs to NCI. So right now we are calculating the fair value of NCI. So we are going to use the shares of NCI. Shiza is saying if the question is silent, then what method will we use? Shiza, if the question is silent and the fair value of NCI is given to you, which means share price of the subsidiary has been given to you, then follow the full goodwill method. If the question is silent, then follow the full goodwill method. Harsh, Ali Hassan, you can ask the question where you are writing how to ask. So you can simply post your question over there. I can see all of your messages. Okay, now Harsh is saying, what if it says proportionate NCI? Then it will be partial goodwill method. Okay, so whenever the question will say follow the proportionate method or proportionate NCI, that will become partial goodwill method. And whenever the NCI, whenever the question will say value the NCI at fair value, this would become full goodwill method. So these are the wordings that would tell us which method to be followed, partial or full. Okay, now let's read out adjustment number 3. This adjustment is comparatively easy. Hamza is asking that why have we recorded the property plant equipment at 4 and why not at its present value? Hamza, because 4 is already the present value. The question said that the present value of the decommissioning is 4 million. So 4 million is already the present value. So that's why we have used 4 million directly. Welcome. Now in adjustment number 3, the question says that the inventory of Latrick company includes goods bought from the Targent company for $2.1 million. So subsidiaries inventory includes goods bought from the parent company. This means that parent has sold goods to subsidiary with the value of 2100. The inventory of Latrick company includes goods bought from Targent company for 2.1 million. So this 2.1 million is the inventory that is held by a subsidiary. Targent company applies a consistent markup on cost of 40% when arriving at its selling price. So 40% is the markup. Markup is equals to 40%. And this 2100 is actually the selling price. This 2100 is actually the selling price from the perspective of parent. So parent has sold goods with a value of 2100 to subsidiary with a markup of 40%. So now we need to calculate the unrealized profit in this, and already a lot of right answers I've got. Simran, this is the selling price made by charged by the parent to subsidiary. So the unrealized profit is going to be 2100 into 40 divided by 140, which is going to be 600. 2100 into 40 divided by 140. So the unrealized profit is actually 600. And this unrealized profit is going to be removed. So the entry is going to be retained earnings debit and inventory credit by 600. But the question has something further to say. Let's see that. The question says that on 28 March 2006, which is just 3 days before the year end, Targent company dispatched goods to Latrick company. Parent has dispatched some goods to the subsidiary. The selling price of $700,000. The selling price was $700,000. And these were not received by the subsidiary company until after the year end. These goods were not received by the subsidiary yet, so have not been included in the above inventory at 31st March 2006. So subsidiary has actually purchased 700,000 of the goods, but they have not yet received them. So this is a case of goods in transit. So $700,000 of the goods are in transit. Now the question further says that at 31st March 2006, Targent company's records showed a receivable of $3 million. There is a receivable of $3 million in the books of parent. This differed to the equivalent payable in subsidiaries records due to the goods in transit. Now parent company, according to the parent company, the receivable is $3 million, and this receivable is from whom? From the subsidiary. So this is a case of payable receivable within the group. Parent has a receivable from subsidiary. Subsidiary has a payable to parent. If I look from the group perspective, is there any payable or receivable on the group? Is there any payable or receivable on the group? The answer is no. The group does not have to pay anything. The group does not have to receive anything. Subsidiary has to pay individually. Parent has to receive individually, but there is no payable receivable on the group. So the entry that we are going to write, adjustment number 2, is going to be payable debit, receivable credit, and the amount of the receivable was, let me check, $3 million. So the receivable is 3 million, and the goods in transit, which is inventory in transit, is of 700, and the payable would become of 2,300. So from the group perspective, there is no receivable, there is no payable, And there is some goods in transit which we have to record, which is of $700,000. So this is the entry to record the goods in transit and remove the payable and the receivable. Similarly, if you are making the individual double entries, that will be more confusing for you. That will be more confusing for you. So do not go into that much of detail. For goods in transit, you can simply say that when parent has dispatched the goods, I have dispatched these pen to sell to you. Now the goods have been dispatched. They are out from my inventory. I would have made an entry receivable debit, sales credit. Receivables debit, sales credit, and cost of sales debit, inventory credit. So we are going to actually remove the profit as well. Yes, Neeraj, in every question you have to remove the payable and the receivable, which is intra-group within the group. We have to remove the intra-group payables and receivables. Yes, Angela, we are going to do this. Yes, exactly, Akbar, you are right. Wahid, we are going to discuss the income statement. We are going to solve two past papers questions today. One relates to the balance sheet and one relates to the income statement. So your question will be covered over there. Now there is one more important point that we have to remember. This 700 that we have recorded in the inventory, 700 that we have recorded in the inventory, is this the selling price from the parent or the cost price to parent? Is this 700 the selling price to parent or is this the cost price to parent? What do you think? Is this the selling price or the cost price? Cooley is saying cost price and everyone is saying sales price. Yes, this is the selling price, because the question has said that selling price of $700,000. This is the selling price, which means that this also includes the profit. And the inventory that we have recorded at 700 is incorrect. The inventory is of not 700, but the profit has also been included in that. So what is the amount of the profit? Again, we are going to use a 40% markup. So we have already used 40% of the markup. So I can again say the unrealized profit is going to be 700 into 40 divided by 140. So the answer is going to be 200. 700 into 40 divided by 140 is going to be 200. So the unrealized profit is 200 and the entry is going to be same inventory credit, retained earnings debit, and this time by 200. So the entry is the same, retained earning debit, inventory credit by 200 and by 600. So what we can do is we can make a combined entry. And we can say directly retained earnings debit by 800 and inventory credit by 800. So I've made a combined entry for both. So I've removed the payable, removed the receivable, recorded the inventory in transit, and then we have removed the unrealized profit. Smita, exactly which area do you want me to repeat? Can you specify? Exactly which area do you want me to repeat? The last part. Basically, the 700 amount was actually the selling price mentioned by the question. So this means that this also includes the profit, unrealized profit. So we have to remove the profit from the inventory. So we have calculated the profit as being 200 and then have prepared an entry as retained earnings debit and inventory credit by 200. Okay, now adjustment number 3 has been done. Now let's move towards the adjustment number 4. This is probably the last adjustment because 5 and 6 are not very important adjustments. In adjustment number 4, the question says that the investment in Amray company represents at 30% of its voting share capital. So this means that the Amray company is an associate to us, and Darjan company uses equity accounting to account for this investment. Equity accounting is the accounting as per IAS 28. Amray company's profit for the year ended 31st March 2026 was 6 million. And Amray company paid total dividends during the year ended 31st March 2026 of $2 million. So the profit was 6 and the dividend is of 2. Now the question says that Darjan company has recorded its share of the dividend received from Amray company in investment income and cash. So we have actually recorded the income by 2. So let's discuss what is the right entry for this. No, Syed Maaz, the entry for goods in transit will always remain the same. The entry of goods in transit will always remain the same. Now let's see, we have a 30% share in this profit and we have a 30% share in the dividend. So the share of profit is 1800 because we are writing the entries in thousands, and the dividend is 600. So if I write down the correct entry, the correct entry for profit is investment in associate debit by 1800 and retain earnings or the share of profit in associate credit by 1800. So we are going to record the share of profit in associate in the retain earnings as 1800. And the entry for dividend is normally bank debit by 600 and the investment income, and the investment credit by 600. So these are the correct entries that should be recorded. Yes, Kuli, you are right. Smita is asking, how do we decide whether it's an associate? Smita, if the holding is above 20 or above, it's an associate. If your holding is 20% or above, it is an associate. Harsh is asking, what have I written in the bracket? It is share of profit in associate, SOP in A. Share of profit in associate. Share of profit in associate. Now if we see what has happened, that the question has recorded an incorrect entry for this. The question has actually recorded this as an income. The question said that the dividend received from Amray is recorded in investment income and cash. So the entry recorded is actually bank debit and retained earnings credit by 600. Now this was the correct entry and this is the incorrect entry. So now we need to record the correcting entry. So I would say the bank has been debited correctly. No need to do that. And the correcting entry is going to be retained earnings debit by 600 and investment in associate credit by 600. So we have to decrease the investment by 600 and decrease the profits by 600. Hamzali is asking, so why dividend is decreasing the investment? Hamzali, this is something technical, logical, and we don't have the time to discuss the logics. This is what you have to do in the exam. Why doesn't matter. What matters? What to do is something that matters. Why to do is something that is not relevant. Simran, credit investment means decrease the investment in associate. So now if I prepare the final entry in the answer, I can prepare a net entry by 1200. Investment in associate debit by 1800, credit by 600, the net impact is 1200. So the net impact of this entry is actually investment in associate debit by 1200 and the retained earnings credit by 1200. So this is the final entry that I'm posting over here, which actually relates to adjustment number 4. And the entry is retained earnings credit and the investment in associate debit by 1200. So this is the final entry that we have to record in the adjustment number 4. And the previous adjustment was actually adjustment number 3. So adjustment 3 and 4 done. Yes, Simran, you can do that that way as well. Actually, the net impact is investment in associate debit, return and incredit. Simran, this is the net impact of these two entries. So you can even record the both of the entries, or you can simply record the net entry. Both the treatments are correct. I've recorded a net entry, Simran, a net entry of all of both of these. Ahmad Ali wants me to repeat the entry number 4. Ahmad, in entry number 4, the associate had a profit of 6 million. We had a 30% share of 1800. So we have recorded the entry for the profit. And then the dividend was 2 million. We had 30% share, which is 600. And the entry was incorrectly recorded by the question. So we have recorded a correcting entry. And I finally posted a net entry of this. We are going to discuss this. Okay, now we have done all of the adjustments apart from last two. So let me read all of the remaining two adjustments. The question says that all profits and losses accrued evenly throughout the year. So this will always be there in the question. There were no impairment losses within the group for the year ended 31st March 2026. There were no impairment losses. Good enough. So now all of the adjustments are done. What will I do now? I'm going to close my working number 1. So the net assets at acquisition would become a total of $45,000. And the net assets at the balance sheet date would become 20,000 plus 27,000 plus 3,800 minus 4,080. So this is going to be 46,720. So the net assets at the balance sheet date are 46,720. So the increase in the net assets is now 1,720, and the parent has a 75% share in this, and the NCI has a 25% share in this. So this 1,720 is actually the post-acquisition profits. So 75% of 1,720 is going to be 1,290, and 25% of 1,720 is going to be 430. So this is the breakup of the post-acquisition profits. 1,290 relating to parent and 430 relating to NCI. Yes, Kuli, we are going to incorporate that directly in the working number 4. Yes, Simran, we are going to complete this question and then we'll be taking the break. We will complete this question first and then we'll move towards the break. Now let's discuss working number 2, which is goodwill, and we have actually already solved a lot of the working number 2. So if we calculate the cost of acquisition, we have already calculated this cost earlier. If I move on the top, this is the cost and the fair value of NCI, 47 and 9. So 47,000 is the cost of acquisition, and the fair value of NCI is actually 9,000. So the sum of this is going to be 56,000. And then we are going to deduct the fair value of net assets, which are at 45,000 at the date of acquisition. So this will give us the goodwill of $11,000. So 47 we had already discussed. Faraz, it will be difficult for me to make a screen of so that you people can take the snapshot directly, but I will. What I can do is I can take the snapshot myself and simply provide to you. This is what I can do. Or else we can try once the question has been completed. Okay, now working number 2 has been done. Let's solve working number 3 now. Working number 3 is actually NCI, where we start from fair value of NCI being the same $9,000. And then we add the share of profit of NCI, which we have calculated 430 in the working number 1. So the value of NCI to be taken in the balance sheet is going to be 9430. Yes, Chiza, I will post the screenshots in the on the WhatsApp group, so you people can take the screenshots over there. So 9430 is actually the value, final value of NCI. Now let's make working number 4. I'm using this space to calculate working 4. So the working number 4 is to calculate the retained earnings. So we are going to start from parents' retained earnings, and then we are going to write subsidiaries share of profit, which is 1290, and then we are going to incorporate the adjustments. Okay. So let's check parents' retained earnings. So parents' retained earnings can be seen from the question, which is going to be the sum of both opening plus for the year, which is 36,000. 20 plus 16 is 36,000. So parents' retained earnings is 36. Parents' share in subsidiaries profit is 1290, and now we are going to incorporate the adjustments. And in adjustment number 1, we have debited the retained earnings by 300. So debit retained earnings would actually reduce them. So adjustment number 0, debit retained earnings minus 300. And then adjustment number 3, debit retained earnings by 800. So I'm giving reference to the examiner. These values have been taken from adjustment number this. And then adjustment number 4, we have a retained earnings credit, which will increase the retained earnings by 1200. So the total is going to be 36,000 plus 1290 minus 300 minus 800 plus 1200, which is going to be 37390. So this is actually the total of the group retained earnings. So all working is done, working 1, 2, 3, and 4. Now I'm going to prepare the balance sheet. And for the balance sheet, I'm going to refer to the question. And I will have to actually remove these values that I've calculated over here. So I'm moving them a bit so that you people can refer to them later as well. Okay. So now this is the balance sheet according to the question, and now I'm going to prepare the balance sheet according to the group. So I'm making this with it so that it's easier for me to use the values. Now I'm preparing the group statement of financial position. So we are going to start from property, plant, equipment, which is 75,200 for the parent. And plus 31,500 for the subsidiary. And then we have investment in associate, which is at 4,500. And then in the current assets, we have inventory, we have trade receivables, we have bank. Inventory is going to be 19,400 plus 18,800. Receivables are going to be 14,700 plus 12,500. And bank is going to be 1,200 plus 600. So this is the debit side. Let's complete this first. And apart from this, we are going to add goodwill, which we have calculated in working number 2. So actually, I would need more space. Okay, now let's complete the balance sheet basic adding, and then we are going to incorporate the adjustments. So on the credit side, we are going to write equity, and we have ordinary shares of parent, which are 50,000. And we have also created a share premium in the double entries. And then we have retained earnings, which we have calculated in working number 4. NCI calculated in working number 3. And then we have 8% loan notes, which are 5,000 of the parent. And then we have current liabilities, 24,000 of parent plus 16,400 for the subsidiary. Yes, Mohammad Imad, we are going to cover consolidation only today. So now this is the group balance sheet that we have made a base for all. Now let's move on to the answers and incorporate the double entries. So we have actually credited the share capital by 10, share premium by 22. So share capital will increase by 10 and the share premium will be recorded by 22. So this would become 60,000 and 22 share premium. Similarly, we have to record interest payable by 300, loan notes by 15,000. So loan notes, I'm adding 15,000 and payable current liabilities, I'm going to add 300. Now I'm just incorporating the entries into the answer. Investment in subsidiary has already been included in goodwill. These have been used as a cost in the goodwill. So this will not impact the balance sheet. And then we have debited the payable by 2,300, inventory debit by 700, receivable credit by 3,000. So receivables credit by 3,000, inventory debit by 700, and the payables debit by 2,300. Moving back to the answer. And then we have credited inventory by 800, debited in the investment by 1,200. So inventory credit by 800 and investment debit by 1,200. So we are just posting the entries. All entries are done now. Adjustment 4 complete, 3 complete, 2 complete, 0 complete. And now the only thing that is left is the working number 1. So if we see, we have actually recorded some fair value adjustments in this. So this 3800 and 4080 is also to be included. So 4080 to be written as a provision for dismantling. This is a part of non-current liability. And in the property, plant, equipment, we have to add what amount? 3800. And finally, the goodwill that we have calculated is of $11,000. So 11,000 is the goodwill. Now we have to calculate the sum, and this would easily balance the balance sheet. In fact, let's write down the value of the retained earnings in the NCI as well. So if I move towards the answer, the NCI is 9430 and 37390. So this is 9430 and 39370. So let's calculate the credit side first. This is going to be 20,000, and this is going to be 24,000 plus 16,400 plus 300 minus 2,300, which is going to be 38,400. So this is 38,400, and let's calculate the total now. So 60,000 plus 22,000 plus 39370 plus 9430 plus 20,000 plus 38,400 plus 4080 is going to give us a total of 193,280. 193,280. Let's check again. 60,000 plus 22,000. 39370 plus 9430 plus 20,000 plus 38,400 plus 4080. Okay, the answer is right. Smitha, please check again. Now let's calculate the debit side, and there is one question from all of you people that I'm going to ask after this, after completing this question. So now property, plant, equipment is going to be 75,200 plus 31,500 plus 3,800, which is 110,500. And then investment in associate is going to be 5,700. And then we have inventory, which is 19,400 plus 18,800 plus 700 minus 800, which is going to be 38,100. Then we have receivable 14,700 plus 12,500 minus 3,000, which is 24,200. And then the bank is actually 1,800, which we can calculate manually as well. Okay. Okay, I have actually written the retained earnings incorrectly. This is not 39370. This is 37390. 37390. So the value total will change. Let me recalculate the credit side first. It is 60,000 plus 22,000 plus 37390 plus 9430 plus 20,000 plus 38,400 plus 4080. It is 191,300. Okay, now let's calculate the debit side. 110,500 plus 5,700 plus 11,000 plus 38,100 plus 24,200 plus 1,800 is going to give us 191,300. So this is how we have actually balanced our first consolidation question. Any questions with this? You can at least take the snapshot of the balance sheet, entire balance sheet. Faraz Ahmed wants to solve the next question on the CB format. Syed Maz is saying that why have we taken the investment in associate? Syed Maz, we do take the investment in associate. The investment in subsidiary is not taken, but the investment in associate is taken. Okay, welcome Angela. Akbar is saying it's clear, sir. I like the way you made working in the form of adjustment 1 and 2. Thank you, Akbar. Okay, now there is a question from all of you. I'm posting a poll relating to that whether you people are appearing in the CB format or the manual format. So are you people appearing in session CB for paper F7 in December 2017? So you have to mark it either as yes or as no. Cooley, you have to mark in the screen that you can see. It is a poll, so this will actually record all of the answers in the system. Okay, quickly everyone, you have to mark the answer. 78% people have voted already. 22% people are sleeping. And 93% people are saying no. And 7% people are saying yes. Okay, so approximately there are very less students who are actually going to give the CB exam. So I would prefer moving towards the CB to the manual format for the next question. Shiza is also requesting. And Faraz is a bit depressed. No problem, Faraz. Don't worry. Don't see what other people are doing, see what you are doing. That is your point. Okay, Sheikh Saqib, we have noted your problem, and what I can do is maximum I can forward to the relevant personnel because I'm just a teacher. I cannot do anything with this. So let's take a break. It's 11:30, 11:43 with me on my tablet. So we are going to take a break. I'm writing on a new screen. Otherwise, people come and ask, why is the screen stopped? It's break, and the break is of 10 minutes time, starting from 11:44 to 11:54. So let's have a break and then continue again. Have something to eat, to drink, so that you people can gain some energy to continue. Okay, everyone, welcome back. So let's insert the new question. Okay, now we are going to solve the income statement question. Sayed Maz wants to know about goodwill working. Maz, this is something now you can discuss on the WhatsApp group. Okay, so there is another question. Let's start with the requirement. The question requirement says that calculate the consolidated goodwill at the date of acquisition for Rackwood Company. So Rackwood Company is probably is probably a subsidiary for us. So we have to calculate the goodwill. So for goodwill, what we need to prepare working number 1, net assets. But this time net assets at acquisition would be sufficient enough. We are not going to require to prepare the net assets at balance sheet. But if you want, you can prepare this parallel. It is not required, but you can perform this. And normally we have a share capital and the retained earnings. And after this, we have to prepare working number 2, which is goodwill. So goodwill would include, or I can prepare the goodwill beside this. So working number 2 will be goodwill. And in the goodwill, we would have cost plus the fair value of NCI and less the fair value of net assets. So this is the requirement of part A to calculate goodwill. Yes, Shira, this is the last question we are going to study today. Because solving question is something more important than studying, because normally when we study, everything that we study is not there in the exam. But every question that we do would have some impact in the exam. So this is why I do remember, then you have short time, focus more on towards the practicing rather than studying. Okay. Now part B says that prepare a consolidated statement of profit or loss for Laurel Company for the year ended 30th September 20x6. So there are 2 requirements, 7 marks for goodwill, easy marks, 13 marks for preparing the income statement, which is again not too much of difficult. Although there will be some adjustments which will be difficult, but not exactly too much of difficult. Sheikh Saqib is saying I didn't get the Excel solution of yesterday's question 1 and 2. Actually, Sheikh Saqib, the answers were on this tablet, and this was not there with me at home, so that's why I was not able to provide you the answers, but I will be providing you today, inshallah. Okay, so let's start reading the question. Now we know what exactly we want. We want goodwill. We want to prepare the income statement. Now the question says that on 1st January 20x6, which is 9 months before the year end, so I'm writing down 9 months so that I remember the months of acquisition. Laurel Company acquired 60% of the equity shares of Rackwood Company in the share exchange, in which Laurel Company issued 3 new shares for every 5 shares it acquired in Rackwood Company. So we have acquired 60% of the shares and we have given 3 shares for every 5. The share issue has not yet been recorded by Laurel Company. Additionally, on 31st December 26, which is 1 year after the date of purchase, Laurel Company will pay to the shareholders of Rackwood Company $1.62 per share acquired, and Laurel's cost of capital is 8% per annum. So we have actually provided 2 considerations, share exchange and the deferred consideration. Yes, Simran, this is the share exchange. At the date of acquisition, shares in Laurel Company and Rackwood Company had a market value of $7 and $2 each respectively. Now let's see, the question has given us some information beneath the income statement, which is about the equity as at 1st October 20x5. 1st October 20x5 means at the start of the year. These values relate to this time. So the shares were 15,000 of the subsidiary and the retained earnings were 25,000 for the subsidiary. So if I calculate the consideration, I would say that out of 15,000, we have acquired 60% of the shares, which will be 15,000 into 60 divided by 100, which is 9,000. So we have acquired 9,000 shares of the subsidiary, and in return we have provided two considerations. Our own 3 shares for every 5, that would become 9,000 into 3 divided by 5. So we have given 5,400 of our own shares. So we have given 5,400 of our own shares. Yes, Simran, you are right. And each share of parent actually has a fair value, a share price of $7. So the consideration share exchange is going to be 5,400 into 7, which is 37800. This is the consideration we have given for the share exchange. And plus, we are also going to pay $1.62 per share given over here. $1.62 per share after 1 year. So we are going to calculate the present value using a discount factor of 8%. So the present value is divided by 1.08 to the power 1. Okay, Simran, just wait. 3,000 into 1.62 divided by 1.08 will give us the present value of the consideration, which is actually 13,500. So the total consideration would become 13,500 plus 37,800. So this will be 51,300. So this is the total consideration that we have given to pay for the purchase of subsidiary. Okay, thank you, Cooley. You had given the answer already. Simran is saying why 3 by 5? Simran, because we are paying 3 shares for every 5 that we have acquired. 3 shares for every 5 that we have acquired. So sort of you can say I'm receiving a bunch of 5 and giving a bunch of 3. So how many bunch I would have received? So this would become 9,000 divided by 5. These are the number of bunches that I'm receiving into 3 that I'm giving. So this will become the number of shares that I have paid. Okay. Neeraj is saying, so can you please tell again for 1.62 and 1.08? And someone is saying, why are we dividing? Actually, the question says that Laurel Company will pay to the shareholders of Rackwood $1.62 per share acquired. So for example, if this is confusing you, what you can do is you can write year. After a year, we are going to pay cash and then the discount factor and then the present value. If you are aware of this, you can do that way. So we are actually paying 1.62 per acquired share. So 9,000 into 1.62 will give us 14,580. This is the cash that we are going to pay. This is the cash that we are going to pay after a year, and the discount factor is 8%. So this will be 1 divided by 1.08, which is going to be 0.9259. So if I multiply this by 14,580 multiplied by 14,580, this is going to give me the present value of 13,500, which I have already written over here as well. That's good, Neeraj. You have got it. Simran, have you also got it? Okay, good enough. So the total consideration is now 51,300, which I'm going to my answer sheet, and I'm going to write the cost is 51,300, which we are going to use to calculate the goodwill. And similarly, the question has also given us the market value of subsidiaries share. So why is this given? Why is the subsidiaries share price given? To calculate the fair value of the NCI. So I would say that we have acquired 9,000 out of 15,000 shares. We have acquired 9,000 out of 15,000 of shares. So remaining 6,000 belongs to NCI and the fair value is 2. So the fair value of NCI is now 12,000, which makes it 63,300. And once we get the net assets, we are going to get the goodwill. And the net assets will be calculated in the working number 1. This working. Any confusion so far? Simran is saying, what's the one below the cost? Fair value. Simran, this is fair value. Okay, and Cooley is saying the net assets. Yes, the net assets we are still going to calculate, and then we are going to get the goodwill. Now let's see the statement of profit or loss. The question is given as the revenue, the cost of sales, gross profit, distribution cost, administrative expenses. There is an interest income with note reference of 4. We have finance cost, profit before tax, income tax, profit for the year, and then we have got the equity. So what we can do is, meanwhile, we can solve the working number 1 as well. So in working 1, the equity of subsidiary is actually 15,000. The equity shares of subsidiary are 15,000. And the retained earnings opening is 25, with the profit for the year being 10,400. So the closing value is 35,400. So the closing value is 35,400. Now we have acquired 9 months back. So I would say 3 months after the start of the year and 9 months before the end of the year. 3 months after the start of the year and 9 months before the end of the year. So can you calculate the retained earnings at the date of acquisition? Retained earnings at the date of acquisition. Harsh is saying 32,800. Neeraj is saying 26,600, 27,600, 27,600. Okay. So either add 3 months profit in 25 or deduct 9 months profit from 35,400. So I'm adding 3 months profit into 3 divided by 12 will give us 2,600. So 2,600 is the profit for the 3 months. So it is going to be 27,600. So in the answer, I'm writing 27,600. And on the balance sheet date, this was 35,400. Although this balance sheet column is not required, but I'm just solving so that if this question would have been a balance sheet question, you could have performed the working as well. Simran, I'm repeating. Either add 3 months profit in 25 or deduct 9 months profit from 35,400. Both will get the same answer. Both will get the same answer. So I've done 10,400 profit for the year into 3 and divided by 12. So this is going to give me the first 6 months profit, 2,600. And then I've added in 25,000 to get the retained earnings at the date of acquisition. Is it clear now? Okay. So now we have completed the working number 1 up to a certain level, and now we are going to read the adjustments. The question says that the following information is relevant. At the date of acquisition, Laurel Company conducted a fair value exercise on Rackwood Company's net assets, which were equal to their carrying amounts with the following exceptions. An item of plant had a fair value of $4 million above its carrying amount. So there's a fair value adjustment of $4 million. At the date of acquisition, it had a remaining life of 2 years. So I'm going to write fair value adjustment of the plant, which was $4 million, which means $4,000. And its depreciation is going to be 4,000 divided by 2 years and into 9 by 12. Why 9 by 12? Because we have acquired since 9 months. So 4,000 divided by 2 is the annual depreciation, into 9 divided by 12 will give us the depreciation for the 9 months, which is 1,500. So the asset will be depreciated by 1,500. So what I can do is I can write a double entry, and I'm writing double entry in such a way that parent entries are going to be written over here and subsidiaries entries are going to be written over here. So I'm writing depreciation expense, which is going to be recorded in cost of sales. So I'm writing cost of sales debit and the property, plant, equipment credit by what amount have we calculated? By 1,500. Or you can even only write a single impact that we have to increase the cost of sales, because property, plant, equipment has no link with the income statement. This is something relevant to the balance sheet, but we can even write it over here. So it's your call either to write a single entry debit cost of sales, that's it, or complete the double entry debit cost of sales credit property, plant, equipment. Credit will even then be, even still not be used. Any confusions with 1,500? Now the second adjustment says that inventory of 800,000 had a fair value of $1 million. So this means that we have to increase the inventory by 200. All of this inventory had been sold by 30th September 2006, and all of these have been sold. So if we are increasing by 200 and all of the inventory has been sold, so we would be required to decrease also by 200. If I'm increasing 200 at the date of acquisition and the inventory has been sold, so I also need to decrease it so that the impact has been nullified. So if I go to the answer, I would say that this is a fair value adjustment on inventory by 200. And as the inventory has been sold by the year end, I'm going to write another entry, cost of sales debit by 200 and inventory credit by 200. This way the net impact on the balance sheet would become 0. Positive 200, negative 200, net impact is 0. Positive 200, negative 200, the net impact is 0. Now why are we deducting 200? Let me tell you this in more detail. For example, parent, subsidiary and the group. Subsidiary has an inventory with the carrying amount of 800 and the fair value is 1,000. This is the case. Now what happens that parent has increased the inventory by 200 at the date of acquisition. And this has been increased in the group financial statements. Am I right? Do you people agree? Is there any problem with this statement? Right, agreed, good. Now when subsidiary would have sold these goods by the year end, subsidiary would have recognized It's inventory. Subsidiary would have derecognized the inventory when it has been sold. Am I right now? Or no? Do you agree with me that subsidiary would have derecognized this inventory when the inventory was sold? Ahmed is saying right. Someone is saying yes. Good. But by what amount? Subsidiary would have derecognized its inventory by what amount? By 800 or 1000? What do people think? Subsidiary would have derecognized inventory by which amount? Harsh is saying 1000, Neeraj is saying 1000, Ahmed is saying 800, Simran is saying 800, Ahmed Ali is saying 1000. Actually, when subsidiary is derecognizing, subsidiary would have derecognized by its own cost, which is 800. Because subsidiary, in the books of subsidiary, the inventory is still at 800. We have increased the inventory by 200, but in the financial statements of the group, not in the subsidiary's financial statements. So when subsidiary has sold the goods, subsidiary would have derecognized them by the amount recorded in subsidiary's books, which was 800. Elvis, are you getting this? That when the subsidiary has sold the inventory, subsidiary would have derecognized it by its own carrying amount, which was 800. But according to the group financials, it was at 2000. So now what has happened, that inventory should further be reduced by 200, as in the group financial statements it was recorded at 1000. So because it was recorded at 1000 the group financials, and only 800 has been derecognized, so we need to further derecognize the 200. And for that we are preparing the entry as cost of sales debit and inventory credit. Are you getting the point now? Ahmad Janind has understood this. What about the others? Is everyone else getting the point? Simran is saying why we are misusing the cost of sales. Simran, we are not misusing the cost of sales. If you see, the cost of inventory to subsidiary was actually 800, but the cost paid by parent is 1000. Therefore, for subsidiary, 800 should be recorded in cost of sales, and for the group the cost should be 1000. So therefore should be increased by 200. So for the group the cost is actually 1000, not 800, but for subsidiary the cost is 800. So subsidiary is recording cost of sales of 800 and the group should record the cost of sales of 1000. That's why we are increasing by 200. Getting the point, Simran? Mahin has got the point, Akbar has got the point. Oh, good. That's good, Simran. So that is why we are preparing the entry as cost of sales debit and inventory credit. But the inventory credit will not have any impact in the balance sheet, in the income statement. This is something that is relevant to the balance sheet only. So I'm moving towards working one, and I'm writing the plant value to be 2500 after charging 1500 depreciation, and the inventory of value is 0 after crediting the inventory by 200. So this working is actually not required, but we are solving this just to show you something. Simran wants a screenshot. Simran, here you go. Take the screenshot. Was this useful when I'm typing, and I'm typing what exactly I mean? Because when the concepts are very difficult, only hearing the words will not make you understand. it's important to write them down and to look them so that your focus increases. Okay, that's good, really helpful. Okay, good. So whenever you people are not able to understand me, do mention this. I will type so that your focus can be increased and the statement can be understood more easily. Now let's move on to the adjustment number 2, where the question says that Laurel Company's policy is to value the non-controlling interest at fair value. Now over here the question has mentioned us that the question wants to follow the full goodwill method, but we already know that this was something required by the question because the subsidiary's share price was given at the date of acquisition. For this purpose, Rackwood's company's share price at 1st January 2026 can be deemed to be representative of the fair value. So the share price is representing the fair value, and we have already used the share price held by the non-controlling interest. So adjustment 2 has already been covered by us. You people are intelligent enough to solve this adjustment even before asked by the examiner. So now let's move on to adjustment number 3. The question says that Laurel Company had traded with Rackwood Company for many years before the acquisition. Sales from Rackwood Company to Laurel Company throughout the year ended 30th September 2026 was consistently 1.2 million per month. So subsidiary has been selling goods to parent for 1.2 million per month, and it has been 9 months since the group structure had been created. So 1200 into 9 is going to be 10,800. So we are going to say that 10,800 of the sales have been made after the group structure had been prepared. Yes, Simran, you are right. So I'm going to make another entry in the books of subsidiary that we are going to debit sales by 10,800 and we are going to credit the cost of sales by 10,800. Whenever there's an intragroup trading, you have to remember one thing. In case of intra-group trading, you have to prepare 2 entries. Entry number 1 is debit sales and credit cost of sales. And the second entry is going to be debit cost of sales and credit the inventory. So always in case of intragroup trading, there are 2 entries: sales debit, cost of sales credit by the amount of total sales, and then cost of sales debit, inventory credit by the amount of unrealized profit. Okay, Simran is asking why cost of sales. Actually, Simran, if you see, we are debiting the cost of sales and crediting the cost of sales. So crediting cost of sales by the selling price and then debiting by the profit. Crediting by selling price, debiting by profit. So the net impact is a credit of cost, credit selling price, and debiting the cost. So we are doing minus selling price and plus the profit. So the net impact would become deducting the cost. So this is how we are doing this. Elvis is saying, when do we impact the retained earnings? Elvis, we impact the retained earnings when the question relates to the balance sheet question. If this relates to the balance sheet question, this is something that I've written for the income statement question. If the question is a balance sheet question, in that case, you are going to debit the retained earnings and you are going to credit the inventory. Bilal is asking, sir, is it compulsory to write down the entries in the paper? Not at all, Bilal. The entries that I'm writing is just to show you the double impact so that you can view a broader picture, not what is required by the question. You can view the broader question, and you can have a more controlled approach towards the exam and the real environment. In the practical life, we record the double entries in this manner. So this is something which is more relevant to the practical world, and again at the same time with the question as well. So I'm going to write another entry which is going to be cost of sales debit and the inventory credit by the unrealized profit. So let me go back to the question. But the question says that Rackwood Company made a markup on cost of 20% on all these sales. So the markup is 20%, and Laurel had 1.8 million of these goods in inventory at 30th September 2006. So the inventory of parent is actually 1800. So the unrealized profit is going to be 1800 into 20 divided by 120. So 1800 into 20 divided by 120. Thank you, Akbar. Akbar is saying the journal entries method is wow. Okay, so 300 is the unrealized profit. So I'm going to write the entry by 300 and cost of sales debit by 300 and the inventory credit by 300. So this is how we have completed the next adjustment, adjustment number 3. If you people have any question, you can ask. Okay, now let's move on to adjustment number 4. This is approximately the last adjustment, and then 5 and 6 are something which are there mentioning that profits are deemed accrued evenly over the year and there was no impairment. These entries are actually not very much important. Simran is saying we don't want to show the double entry impact in the exam. Simran, this is your call. If you want to show them. If you don't want to show, don't show them. It is not necessary. But showing the double entries impact will give a good impact to the examiner, that you know the entire impact of how to incorporate these. Okay, Harsh wants to see the double entries. These are the double entries. And Harsh, if you want these entries, these are also there. So you have the question impact and the normal general impact. So you can take a snapshot. Welcome. Okay, now moving back to the question, where the question says that Laurel Company's investment income consists of which investment income? Let's move towards the income statement. The question is talking about this investment income, this one, about the 500 one. So what is the question mentioning? This is the 500 that the question is talking about. So let's see what does the question wants to say. Now the question says that Laurel Company's investment income consists of its share of dividend of 500,000 paid by Rackwood Company in August 2006. Its share of dividend of 500,000. So this is the dividend received by the parent or the entire dividend paid by the subsidiary? This 500, is this dividend received by the parent or of the entire subsidiary? What do people think? Of parent only or the entire subsidiary? Simran is saying received by parent, Wahid is saying received by parent, Harsh is saying received by parent, but Neeraj is saying right, this is the dividend paid by entire subsidiary, because the question says that investment income consists of its share of a dividend of 500 paid by Rackwood. This is the dividend paid by Rackwood. So we are going to calculate 60% of this and 300 is the dividend that we have received from the subsidiary. The dividend received by parent is actually 300, not 500. The dividend received by parent is actually 300, not 500. 500 is the entire amount paid by the subsidiary. Similarly, if you see the next statement, a dividend of 200,000 received from Arctic company. Now over here the question mentions paid by Rackwood, 500,000 paid by Rackwood, and 200,000 received from Arctic. So the amount of 200, now is this amount paid by the associate or received by the parent? What do you people think? 200, is this amount paid by the Arctic or received by parent? Yes, this time this is received by parent. So parent has received 200 of the dividend from associate and 300 of the dividend from subsidiary. So the total dividend is now 500, and this is the amount given in the trial balance. This was your question, Simran. Then why has been 500 given in the trial balance or the income statement? Because that is the sum of both 300 and 200. 500, the amount given in the income statement, it belongs to both. So a dividend of 200,000 received from Arctic company, a 25% owned associate, which it has held for several years. So do we record dividend income from subsidiary or associate? Do we record dividend income from the subsidiary or associate? No, we do not record from either of them, not from subsidiary nor from associate, because the dividend received from associate has an entry of bank debit, investment in associate credit. It is not an investment income. So the amount received from associate is actually bank debit and investment in associate credit, and the amount of 300 is actually an intragroup transaction. So both should be eliminated. Both should be eliminated. So dividend received from associate is not an income to us. It is not an income to us. Simran is asking why, but I'm not going to answer this question of yours, Simran, because this is something that would require me to go into too much detail of associate and to make you understand the entire concept of the associate, which is not possible in the revision session. No, Simran, no, not even briefly, because there is no brief description of that. Ahmed, the dividend received will come in the retained profits section, right? Basically, okay, let me explain you people. Your questions are showing me that you people do not have the concept of the associate, but considering the time constraint, I'm going to make you people understand just a bit, not the entire concept. So do listen this carefully. Now, for example, I have made an investment in a company. I have made an investment in a company. What should be the entry? I have made an investment in an entity. What should be the entry? The entry is going to be investment debit and the bank credit. Agreed? I have made an investment in a company, investment debit, bank credit. Now let's suppose I have made the investment by $100 million. I have made an investment by $100 million. Let me write this with pen. So I've made the investment by $100 million. Now, for example, I earn a profit of $10 million on this. I earn a profit of $10 million on this. What should be the entry? I earn a profit of $10 million from this. What should be the entry? The entry should be income credit by $10 million. And what else? What should be the debit? What should be the debit? Ahmed is saying investment debit. No, Simran, not that I've sold them. The company has earned a profit. I have made an investment in a company and the company has earned a profit of 10. So my entry is going to be investment debit, income credit, because my investment has increased. Any undistributed profits increases the investment of the shareholder. So now I would say that my 100 million were already invested, and the profit which has not been divided into the shareholders is a reinvestment. The profit not distributed is a reinvestment. So the company has reinvested $10 million. So now my investment has become 110. But for example, if I say that the company has earned a profit of 10, the company has earned a profit of 10, but has given the dividend of 2 million and have reinvested 8 million. The company has given a dividend of 2 million and has reinvested the $8 million. Now what should be the entry? The company earned a profit of 10, gave a dividend of 2 to me and have reinvested 8 million. Now what should be the entry? The entry should be bank debit by 2 million and investment debit by 8 million and retain earnings credit by 10 million. Am I right? We have earned 10, we have received 2, and we have reinvested 8. Do you people agree with me on this entry, or is there any confusion with this? Is this entry clear to all of you? Agreed, understood. Yes, good. That's good. Now let me rephrase the entry. If I say investment debit by 10 and I say retain earnings credit by 10, and then I make a new entry, bank debit by 2 and investment credit by 2. Now if you look at this entry, investment debit by 10 will increase the investment by 10 and the credit by 2 will decrease the investment by 2. So the net impact is 8 million, same. Bank debit by 2, same. Retain earning credit by 10, same. So both the entries are the same. So normally what we do is we make these entries for an associate. We first assume that the entire amount has been reinvested. And whenever we draw the profit in dividend, we say that the reinvestment amount has been reduced. So if the reinvestment has been reduced, the investment will also be reduced. I'm writing it again because this is something difficult. We assume that the entire profit has been reinvested. We assume that an entire amount has been reinvested. Therefore, we prepare this entry. This is your question also, Simran. We assume that the entire amount has been reinvested. So that would increase the investment and the profit. And when the dividend is being paid, we reduce the amount of reinvestment, hence reducing the investment also. So we are assuming that the entire amount has been reinvested. Thank you, Amzali. So first we are assuming that entire amount has been reinvested, and then when we receive the dividend, we reduce the investment. Is everyone getting this? Is everyone getting my point? Okay, everyone has got this. That's good enough. Now there's one more question from my side. Why do we assume like this? Wasn't this entry a bit simpler? Why don't we just follow that, and why we are solving with an assumption and then correcting that, and so much lengthy process? Why do we do that? What do you people think? Why do we do that? This is because the profits are recorded only once in a year, which is at the year end, but the dividend can be paid multiple times in a year and not necessarily at the end of the year, due to which the timing of recognition of profits and the dividend becomes different, resulting in the entries to be recorded separately. Did you get the point? Because the profits are recorded only once in a year, which is at the year end. But the dividend can be paid multiple times in a year and not necessarily at the end of the year, due to which the timing of recognition of profits and the dividend becomes different. The profit is being recorded at a different time and the dividend at a different time. Therefore, the entry should also be recorded separately. That is why we have made two different entries, and assuming that the amount has been reinvested, and whenever the company pays a dividend, we say that the amount reinvested has now been distributed. So reduce the amount of reinvestment and reduce the amount of investment and prepare the above entries. Getting the point? Simran, I have not made 3 entries. It should be just 2. Either prepare this entry, investment debit, return earning credit, bank debit, investment credit, or the first one. This is an option 1 and this is an option 2, but we follow this option 2. Okay, Neeraj is saying the typing is really beneficial. No, Simran, you cannot choose, because the reason I have mentioned over here that why you cannot choose this. You have to prepare separate entries. Okay, now let's move back, and I told you that this is something that would take time, and even still I haven't discussed the entire overall concept of the associate. This was just a brief explanation. The entire concept is, I would say, a big river to understand that. Okay, now, so we are going to remove the dividend of 500, 300 received from the subsidiary and 200 from the associate. So instead of making the question complicated, what we can do is we can simply cancel this off, and we say that we are not going to include this in the statement of comprehensive income. We are not going to include this 500 while we're preparing the consolidated statement of comprehensive income. So I'm not preparing a double entry for this. I'm simply canceling all this off so that it is easier for you people to digest. Welcome, Simran. Welcome, others, Simeon. Okay, now the question further says that the profit after tax of Arctic company for the year ended 30th September 2026 was $2.4 million. So the profit of associate was $2.4 million, and we have a 25% share in this. So 25% of 2.4 million is going to be 2400 into 0.25, which is going to be 600. So our share of profit is 600. So the entry for this is going to be recorded in the books of parent as, this is adjustment number 4, and I'm going to say investment in associate debit by 600 and share of profit in associate credit by 600. Now this share of profit in associate, is basically a separate line item. So I'm writing in the brackets that share of profit in associate is a separate line item created in the income statement before the profit before tax. So when we are writing profit before tax, we are going to write the share of profit in associate before that. It is a separate line. It is a separate line. It is a separate line, a new line. When I will prepare the income statement, then you people will understand this even better. So just wait for a while to understand this. And now let's quickly complete the adjustments and then preparing the income statement. So the question says that assume, except where indicated otherwise, that all items of the income and expense accrue evenly throughout the year. That's good. There was no impairment losses within the group during the year ended 30th September 26. That is great. So now we are done with all of the adjustments. So if I close my working number 1, I would get the net assets at the date of acquisition, which are going to be 15,000 plus 27,600 plus 4,000 plus 200, and this is going to be 46,800. So 46,800 are the net assets acquired, and the goodwill would become, yes Simran, you are right, 63,300 minus 46,800 is going to give us the value of goodwill, which is 16,500. This is the value of the goodwill that should be recorded, and this was your answer to the 7 marks question. And I think that these 7 marks were actually easy marks. There's nothing difficult in these 7. There was some level of difficulty in the dividend, but the amount which is not difficult is these 7 marks. Simran, this is something not required, so even if you're not getting this, not necessary. Not necessary. But I'm still calculating this total. So the total would become 15,000 plus 35,400 plus 2,500, which is going to give you 52,900. So you can calculate this, but this is something which is not necessary. For example, if we are solving the balance sheet, then this would be required. Yes, Bilal, you can calculate the profit attributable to from this as well as somewhere else. That is why I'm preparing this, to prove that there are 2 different methods to calculate the profit attributable to NCI. Neeraj is saying that if we have taken 7 marks, 43 can be taken from MCQs and ratios. Yes, Neeraj. Okay, yes, Maz, you are right, but this is something again which will complicate everyone, so I'm not going into too much detail of that. So now let's prepare the consolidated income statement. For that, I need to prepare some space, and I'm selecting all these values. And I'm moving them forward so that I can get the space over here. Okay. Now let's prepare the income statement. So the revenue is going to be 84,500 plus 52,000 into 9 by 12. The amount of revenue which you have to write in the exam. Let me type, that would take less time for me. Revenue will be 84,500 plus 52,000 into 9 by 12. And further, there are some adjustments. What are the adjustments? We have actually debited the sales by 10,800. So we need to minus the sales by 10,800. We are debiting the sales by 10,800. So we need to minus this by 10,800. And then we have cost of sales. Cost of sales is 58,200 plus 34,000 into 9 divided by 12. And then again we have some adjustments. And the adjustment is debit 1,500, debit 200, credit 10,800, debit 300. A lot of adjustments. So let me learn first. 1,500, 200, 300. Plus 1,500, plus 200, plus 300, and then minus 10,800. So this will give us the total of cost of sales. And then we will be having the gross profit. And after gross profit, we have distribution cost, administrative expenses, and then we have investment income, and then we have finance cost, and then we have profit before tax. But prior to profit before tax, I'm going to write share of profit in associate, and then I'm going to write the profit before tax, the tax expense, and the profit after tax. So this is the income statement. So the distribution cost is going to be 2,000 plus 1,600 into 9 by 12. And the administrative expense is going to be 4,100 plus 2,800 into 9 by 12. And the investment income is simply going to be 400 into 9 by 12. And the finance cost is simply going to be 300. Share of profit is going to come from the adjustments, and the tax is going to be 4,800 plus 3,600 into 9 by 12. So let's see if we have incorporated all of the adjustments. So cost of sales done, inventory is something not relevant. So now investment in associate not relevant. Share of profit in associate is 600. So we have written 600 with this. So now we have to simply calculate the value. So this is going to be 84,500 plus 52,000 into 9 by 12 minus 10,800. So this is going to be 112,700. And then we have cost of sales as being 58,200 plus 34,000 into 9 by 12 plus 1,500 plus 200 plus 300 minus 10800, which is going to be 74,900. So 112,700 minus 74,900 is going to be 37,800. Then 2,000 plus 1,600 into 9 by 12 is going to give us 3,200 negative. I hope I'm not going too fast. You people are able to catch me. Yong, if you are solving the CB format, you do not need to show this working in the bracket because this would already be there in your Excel cell. Why the reason why I'm showing over here is because I'm not using the Excel right now. So administrative expenses is going to be 300. Investment income is going to be 400 into 9 by 12, which is same. I think I've made some error. 4100 plus 2800 into 9 by 12 is going to be 6200. So this is 6200, and then the finance cost is 300, share of profit is 600. So now the profit 37,800 minus 3,200 minus 6,200 plus 300 minus 300 plus 600 is going to be 29,000. And then the tax expense is going to be 4,800 plus 3,600 into 9 by 12, which is 7,500. So 29,000 minus 7,500 is 21,500. Okay, so now let's see. Bilal, Simran is saying a bit too fast. Yes, Simran, this was just a clerical work, calculating, adding, deducting. So that is why we have I've done so fast. But you can try it on yourself as well later. You just have to see how the values have been calculated right now. Simran is saying, why is everything 9 by 12? Simran, because everything is 9 by 12 because we have acquired the subsidiary 9 months ago. That is why we have done this. Okay, but I think we have left one more thing. The question was silent about whether the finance cost has been recorded for the deferred consideration. So if we see, we have calculated the deferred consideration as being 13,500. So if I calculate the 8% of this into 9 by 12 to see what amount I'm going to get. So it is going to be 13,500 into 8% into 9 divided by 12, which is going to be 810. So the finance cost is 810 relating to the unwinding. So this 810 should also be included in the finance cost, which will make this finance cost 1110, and the profit of 29,000 will actually decrease by 810, so it is going to be 28,190, and minus 7,500 is going to be 20,690. So you also have to check whether the finance cost on any deferred consideration has been recorded or not. Which previous slide, Simran, can you please mention? I am not able to understand which slide are you talking about. Okay, the deferred consideration. Here you go. Thank you, Benedicta. So you people have 2 minutes for the feedback, and then we are going to complete the income statement. We still have to calculate the profit attributable to parent and NCI. So you have 2 minutes for feedback of today's session. Okay, Simeon is saying that I've missed most of his questions. I'm sorry, Simeon, if that is so, although that was not something intentional. Yes, Harsh, you can follow any of the format. There is no requirement for the format. Okay, so now let's continue and complete the income statement. Now the last part that has been left is actually the profit attributable to parent and NCI. I have some space. I have some less space from writing it over here. Profit attributable to parent and NCI. So now we are actually going to attribute the profit from 20690, the profit after tax, that how much of this belongs to parent and how much of this belongs to NCI. So the profit of the parent is actually going to be the balancing figure. And we are going to calculate the profit of NCI. And how are we going to calculate this? We are actually going to see the profit of subsidiary itself, which was 10,400. And we are going to adjust that profit of the subsidiary to get the NCI. So I would say that there are total 4 steps to calculate NCI. And what are those 4 steps? Take subsidiaries individual profit, which in this case is 10400. And then the second step is to time apportion this. By time apportionment, we mean 9 by 12. Because we have acquired the subsidiary only 9 months back. So we are going to multiply this by 9 and divide this by 12 so that the amount that we have consolidated is calculated. And then we are going to adjust the profit for subsidiaries adjustments only. What do we mean by subsidiaries adjustments? Means the double entries that we have recorded in the books of subsidiary. So we have actually debited cost of sales. So debiting cost of sales will decrease the profit by 1500. So I would say minus 1500. Debit cost of sales minus 200. Sales and cost of sales will cancel automatically. And then debit cost of sales is minus 300. So the total impact is minus 2000. So the adjustments are actually reducing the profits by 2000. 1500 for the first adjustment, 200 for the second double entry, and 10,800 has been cancelled automatically, and then 300 for the last adjustment. So the profits should be reduced by 2000. And then we are going to apply the NCI percentage, which in this case is actually 40%. So your answer would become 10,400 into 9 by 12. Which is 7,800. And then minus 2000, which will become 5,800. And then we are going to take 40% of this. So 5,800 into 40 divided by 100 is going to be 2320. So this is the value of the profit that has been attributable to NCI. 2000 breakup is 1500 negative. 300 negative, 200 negative. Sayed Mas, this was your question. Step 3 is basically that we are taking the adjustments that relates to subsidiary. For example, the depreciation charge on the fair value adjustment would affect both parent and NCI. The depreciation on the fair value adjustment would affect both parent and NCI. Similarly, the intragroup trading will affect both the parent and the NCI. So now if I write 2320 over here in the NCI, so I'm going to get the balancing figure, which is going to be 20690 minus 2320, which is 18370. So this is the final breakup of the profit attributable to the parent and the NCI. Okay. So I'm zooming out so that you people can take a complete snapshot of the entire value. So one snapshot for this you people can take simply. I'm trying if I can also take the snapshot. But I think I don't have any option of taking the snapshot myself. Okay, so one snapshot taken by you people. Yes, Yong, both are the same. Now you can take the snapshot of this. Okay, and is there anything else? Nothing else? Now let's move on to the answer sheet. So you people can take the snapshot of this too. Done. Now I'm moving towards the previous question, Dargent, so that you people can take the snapshot of this too. This is the first snapshot. Take it quickly. And then this is the remaining part. Simran, now we are going to end the session because we have already completed the time. And now this is the answer. So you can take the snapshot of this too. The working 1, 2, 3 and the double entries and the working 4. Similarly, in tomorrow's session we are going to discuss the ratios, which is almost supposed to be a compulsory question in the exam. So ratios is something very important. Don't miss out tomorrow's session. So that is all, everyone, for today. Thank you so much and looking forward to see you all tomorrow. Thank you.